You can correctly predict a stock's direction and price target, but still lose 100% of your investment if you get the timeline wrong. Many traders rush to options for the allure of massive leverage, viewing them simply as cheaper stock. However, this misconception ignores the fundamental structural difference between owning an asset and renting a contract. Buying stock is a linear trade with delta 1 exposure. If the stock moves up $1, you make $1 per share. Buying an option is nonlinear, introducing variables like time and volatility that change your profitability curve. Think of stock ownership like buying a house. You have equity forever and time is neutral. Buying an option is like renting a penthouse for a weekend. It's cheaper upfront, but you have a mandatory move-out date. The primary cost of this rental is theta, or time decay. Every single day, the extrinsic value of your option erodes, meaning the stock must move fast enough to offset this daily rent. This creates a break-even hurdle. While a stock buyer breaks, even if the price stays flat, an option buyer starts in a hole and must climb out just to reach zero profitability. Let's look at the break-even math. If you buy a $100 call for $2, the stock must reach $102 just for you to make your money back. A 1% gain in the stock results in a 0% gain for you. Therefore, in a low volatility, slow grind bull market, stock is superior. The leverage of options works against you when the price movement is too slow to beat the theta decay. However, options become the superior tool when you need convexity. This is the ability to make exponential returns on explosive moves because your gamma increases your exposure as the price rises. Another critical factor is implied volatility, IV. Buying options when IV is high is like buying insurance during a hurricane. The premiums are inflated, putting you at risk of IV crush even if the stock moves your way. Conversely, buying options when IV is low offers cheap leverage. If volatility expands later, your option increases in value from both the price move and the rising volatility premium. The strongest argument for options is actually risk management, specifically defined risk. Stocks can theoretically gap down to zero overnight, causing catastrophic losses. With a long option, your loss is capped strictly at the premium paid. Even if the stock gaps down 50%, you can simply walk away from the contract, limiting your drawdown. So how do you decide? Use stock for long-term holds, dividend capture, or when you expect a gradual trend. You don't have to worry about timing the move perfectly. Use options for events or specific catalysts. If you expect a breakout, an earnings surprise, or a technical bounce within a specific time frame, the leverage pays off. We can formalize this into a decision tree. First, ask yourself, do I know when this move will happen? If the answer is no, stick to stock to avoid fighting the clock. If you have a specific time frame, check the implied volatility. If premiums are historically expensive, buying straight calls or puts you at a disadvantage due to mean reversion. Finally, consider your capital efficiency. If buying 100 shares ties up too much of your portfolio, options allow you to participate without overconcentration, provided you accept the 100% loss risk. Remember that leverage is a double-edged sword. It amplifies gains when you are right, but it amplifies the speed of losses when you are wrong or simply stagnant. A common hybrid strategy is the stock replacement. This involves buying deep-in-the-money leaps, long-term options, which mimic stock behavior with less theta decay but higher capital efficiency. This provides a delta near 0.80 or 0.90, giving you most of the stock's upside, while cutting your capital requirement in half, blending the benefits of both worlds. Ultimately, stock is for ownership and investment. Options are for speculation and hedging. Don't confuse the two roles in your portfolio. To summarize, buy stock for the slow grind. Buy options for the explosion. And never buy options just because you can't afford the shares. Choose the instrument that matches your thesis, not just your budget.